All right, Rayne, thanks for joining me. The recording has started, so if everybody out in the audience, if you'd like a copy of this, please give us a shout and we'll be happy to share it with you or any of your friends after the presentation. My name is Joe Garon, and I am a residential mortgage advisor with Embrace Home Loans. And I've got my partner over here, Rayne Wu with National Realty. Rayne, you want to introduce yourself?
Yeah, sure. Hello, everybody. My name is Rayne Wu. I work at National Realty, so I'm super excited to work with all of you in Northern Virginia. I started my real estate career in Boston, Massachusetts in 2001, and things have changed a lot. So I'm super excited to dive in to see how things are changing for both sellers and buyers in Northern Virginia. So you want to take us away there, Joe?
Absolutely. All right, we'll dive right in. And I'd like to take everybody back a little bit further than the most recent past so we can look at really where we've been and then where we are now. So we're looking all the way back to 1990 and looking at the appreciation in home values over time. And as everybody can see, we've got a huge buildup with nearly 10% appreciation rates, really leading all the way up until that great financial crisis period, where we started seeing a little bit of deceleration. And that period was met with a lot of quantitative easing. And that's a word that we've had to reintroduce into our vocabularies again in this most recent economic pullback with the coronavirus. And so as you can see, coming out of the crisis, we had rises in home values, and we were seeing a resurgence in the value in DC, outpacing Maryland and Virginia for a good bit there through the mid-2000 teens. But really, once we got into the pandemic period, we were seeing a lot more of an exodus from cities into suburbs where people had more room, both for work from home as well as to get out and enjoy the environment without having to interact with other people. So really here in 2019, 2020, and even 21, the valuation of DC properties lagged behind those of Maryland and Virginia. Jumping more into some of that quantitative easing talk, we're looking at the mortgage-backed securities graphs going back to January 1 of this year, all the way through July 1 or June 30 of this year. As you might have been able to tell, red is bad, green is good. And anywhere that there's a orange triangle was when there was major financial news that shaped the way that the markets performed those last few days. So in that top left-hand corner, when we started getting really poor news about CPI data, inflation, purchasing managers indexes, all indicating that we were heading into a period where we were going to see very high inflation caused by both supply side shortages that you've been hearing about, but also high demand. That caused a lot of inflation, meaning that the Federal Reserve had to increase the cost of borrowing money to slow things down. There's a few of these points along the way where we saw very large shifts, even though the Federal Reserve was telling us along the way that they were going to be increasing that federal funds overnight rate by 0.5% every single meeting they had. Where we ran into some of the biggest changes was more recently down in this bottom right-hand corner. And I'm going to zoom in a little further on what that looked like here in this red box. So we had started to see inflation tapering, and markets had responded very positively. Relative to the beginning of the year, though, at this point, we were already up 2.5% to 3% on most mortgage rates. But what happened right here in this red box period, early June, we found out that inflation was continuing to surge. And that's when rates jumped a further 1.5%. And that was because the Federal Reserve started quantitative tightening, which is the opposite of quantitative easing, taking money out of the market, as well as raising that federal funds overnight rate by 75 basis points, which is higher than they have done in many years and higher than they had told the markets they would be doing. A lot of what inflation entails in our market is expectations. And so when inflation expectations are not changing, it also takes a Federal Reserve action that is unexpected to change those expectations. And so the biggest question that I've gotten from borrowers recently, which I'm sure you've heard as well, Rayne, is this a good time to buy? I feel like things are so uncertain right now. I've been hearing a lot about it on the news. Rayne, how are you talking to your clients about, the period we're seeing right now and what it means for them?
Yeah, that's a great question, Joe. I mean, I'm actually at a beautiful place in Vienna looking at relatively new construction with buyers that my agent is showing buyers. And, I tell buyers today that it's actually a better time to buy now because inventory is building up. You have more choices and you're not overpaying. You're not going to be putting in an offer with like 20 offers and you're competing against all these other offers, or you're not going to feel super rushed because there's just more to choose from. On the flip side, I think you've talked about the mortgage-backed security and the quantitative tightening, where mortgage rates are going up. I think we can talk about this offline with those buyers that are interested. There are other loan products that you know very well, Joe, that for VA loans, for other portfolio loans from banks, where you can get a lower mortgage rate, or there's also the option of owner financing. So I know a lot of sellers that have VA loans or have the assumption clause for owner financing. It's definitely makes their place a lot more marketable if they can help a buyer, for example, assume their loan at a very low mortgage rate when they bought their place and they're going to assume it. But it's a challenging market for buyers on the flip side, meaning that prices are going up still, but inventory is going up. So it's challenging, especially for the first-time home buyer. It's very, very challenging unless you've got a lot of money saved up, unless you're getting a gift from someone to help you buy your first place. So that's kind of what I'm seeing on the buy side. On the sell side, I think I'm having a lot of tough conversations with sellers to lower their list price. And the reason why, I think, if you can help us understand, Joe, it's just about the monthly payments. As mortgage rates go up, listing price has to come down. Buyers are shopping based on a monthly payment. So those are my thoughts on the buy and sell side.
Yeah, thanks for all that. We're going to jump a little bit further in, but I'm definitely going to touch more on some of the mix of how people are purchasing properties, whether it's cash or different kinds of loan products, and a couple of those other points you touched on as well. This next slide, Rayne and I have been looking at the last 3 months of data in the Fairfax County area and looking at the price per square foot and breaking it out by fee simple properties versus condominium. So I think this is a good time to take another step back, look at the wider picture. Rayne, can you talk to our first-time homebuyers about the difference between a fee simple property and a condominium?
Yeah, definitely. For a lot of first-time home buyers, traditionally they would have bought a condo because the sales price is a lot lower. However, when you factor in the high condo fees and just look at it purely from a monthly payment perspective, a lot of first-time home buyers are surprised. I mean, even for the buyers that are here right now, they're actually looking at a townhouse in Vienna and not a condo. Because if you're looking at it from a monthly payment perspective, when you have a $400, $500, $600 a month condo fee versus a $100 HOA fee, that $400 of condo fee differential between HOA and condo fee is a lot of buying power that you have when you're buying a townhouse versus a condo. And obviously the other aspect of it too is in terms of resale value. Obviously a lot of our buyers, when they buy their first place like a condo, they oftentimes upgrade to a townhouse, single family, as they get married, have kids, have more pets, and so forth. And we're also seeing a lot of multi-generational purchases, meaning a lot of parents are actually moving in with their kids or vice versa. So that's kind of what I'm seeing. So, I think it would be great to kind of dive in a little bit deeper, Joe, in terms of what it means for a first-time home buyer from a monthly payment perspective, looking at closer to the city versus further in the city in the suburb.
Yeah, using that example you just provided there, if the condo fee really is $400 difference between a single family townhouse or a condo, that's almost $80,000 that they could have spent on their purchasing power. So the rule of thumb I like to use is every $50 of condo fees is equivalent to about $10,000 in purchasing power at that same exact monthly payment. And I think part of the rest of this data shows that some of the condo restrictions might be depressing property values on a square foot basis, just because it might be harder to upgrade in the same way you might do a townhome or a single family, relative to what kind of standards you have to meet within that complex, but also the amount of space you have with which to continue to expand the property and make it fit your lifestyle. Jumping over a little bit more onto the condo fee side of things, we've mapped out the average condo fees per month across Fairfax County. Left side of this chart is showing condos, right side is showing single families. So the thing to take away from here, on the right side, there's some small pockets in Alexandria, in McLean, and in Reston, where HOA fees are slightly higher than the rest, but in general, HOA and HOA fees for townhomes and single-family residences are a little bit lower than for condos. And what you're seeing on the left side here, really high fees in downtown Alexandria, right outside of Alexandria City, in McLean, where you've got a lot of those high-rise older buildings, and then in Reston as well. Rayne, can you give us some insight into some of these darker areas, especially for condos, where buyers can expect to see a higher condo fee per month?
Yeah, absolutely. I used to live in Alexandria, and I love Old Town Alexandria. And the thing is, there's a lot of really, really nice waterfront condos. There's a lot of really nice condos that are near Old Town or Del Rey. And they do come with a lot of high condo fees. But, I always think about it in terms of the buyer profile. They could be a retiree they had a single family for many, many years, and they're retired now. They just want to travel and just kind of enjoy their retirement life. So I don't ever tell a buyer that, a condo is better than a townhouse or a single family, because I think it really depends on what stage of life they're in. But it is true, though, that condo fees are quite high in places that you mentioned, like Old Town Alexandria, in Tysons, in McLean, because there's people that want a hassle-free, maintenance-free lifestyle. And for those people, I think those condos are perfect because they are busy working. They just don't have time to do some of the things that other people enjoy doing in part of their lifestyle. They don't want to take care of a yard. They don't want to, take care of a garden. They just want a place they can come home and relax. And I've seen many, many really nice condos. And I think that makes sense for some people. And believe it or not, Joe, a lot of times those condos are owned by people where their second or third home is actually not their primary residence. They're just buying a condo because they happen to have to be in DC. They actually live in New York City, for example, or they live in Chicago, or their primary residence is in another city. They just happen to own a really nice condo in the DC area in the DMV because they're doing business here and they're in town quite a bit. So that's kind of some of the things that I've seen from buyers. But, I would say the mass majority of buyers, I would say probably 60 to 80% of buyers, they're leaning more towards the townhouses. Because if you think about it, for the same amount of money, if you could live in Old Town Alexandria, that's a 1 to 2 bedroom versus a townhouse, or in Tysons, if you can live in a 1 to 2 bedroom condo, nice high rise, or in a nice townhouse, many people, at least people that are beginning their life together, just got engaged, just got married, maybe just had a first kid and they lived in a condo. Many of the buyers that are looking to get a townhouse because they want more space, and they're willing to go further out because during the pandemic, a lot of people are working from home. They're willing to go further out because they want more space for the money. So that's kind of what I'm seeing overall in some of my conversations with buyers, condos versus townhouses.
Awesome. So I'm going to move over into some rules of thumb for first-time homebuyers, or even any homebuyer or realtors that are on the call, that you can use when talking to people. Just really quick back of the napkin math here. Every 1/8% increase we saw in mortgage interest rates equates to about a $50 a month payment increase. And then same thing with purchase price. As those were increasing, every $10,000 of purchase price went up. That equated to a $50 increase in principal and interest payments. And then, like we touched on earlier, that condo HOA fee, every $50 that increases is going to drive down your purchasing power by about $10,000. So I tried to keep all the rules of thumb so that, we're working in $10,000 increments. If you work in hundreds, just double all of these and you'll be able to do some really quick math to determine, how your affordability of a home works versus another. So I want to draw everybody's attention to a kind of a comparison in time here. What we were seeing sort of late spring market heading into the summer market, things were really hot. We were seeing days on market very low, many well renovated, well kept properties going same day they were listed, same weekend they were listed, with 14, 15, 20 offers. And then flash forward to late June, after we've had some really tough crackdowns by the Federal Reserve on interest rates. We had interest rates for most mortgage products up about 1.5%. So going back to our rule of thumb from above, that's a $600 a month increase in your monthly payment. And so from the buyer's perspective, their purchasing power just went through the floor. They may have been looking at $500,000 townhomes. Now they need to be looking at $400,000 townhomes. And then from the seller's perspective, a lot of those people were getting into the late spring market, early summer market after having conversations with neighbors, with realtors about where they needed their property to be in order to be in a good spot to sell. Maybe they had to do some repairs, and we all know that laborers and repairmen were in very short supply early this year, both from a materials perspective, but also just because there was so much demand for people upgrading their homes. And so some of these sellers made it to the market a little bit late just because of that interest rate increase. And so the result from my side is an imbalance or in power between sellers and buyers. Whereas the last 2 years have really been dominated by sellers. They've been able to demand higher and higher just prices with escalation clauses. They've had buyers waiving all of their contingencies and really just having control of the whole process. So Rayne, from your perspective, I know you've been working with a lot of people on the list side. How have those conversations been going with people looking to list their home now, thinking back to what their expectations might be?
Yeah, that's a great question, Joe. I would say that it's been very difficult conversations that I've been having with sellers, both ones that aren't able to sell their listing, meaning they were expecting to sell it within the first open house and just has been on the market and hasn't sold. So those have been really difficult conversations. And I think for sale by owners and some of the new listings that I'm getting, I've been trying to be very realistic with them about pricing things right and making sure that we price things right and we market it right and we get them the best price possible given the shift in the market. Because I think the market is shifting. It is still more of a seller's market because I think there's not a huge buildup of inventory. But, as we go from the 2 to 3 months inventory to 3 to 4 plus, if we get to 6 months inventory, it's going to shift to more of a buyer's market, maybe in the fall or later this year. So those are some of my thoughts talking to sellers recently.
Yeah, a lot of what I've been hearing is people starting to drop those list prices, maybe $30,000 to $50,000, and that goes a long way towards bringing the purchase price from a borrower's perspective, which for me is the monthly price they're paying, and not necessarily that $500,000 price tag that's on it. For me, when you bring that in line with whatever the most recent buyer down the street paid on a monthly basis, I think we're going to see that there's still quite a bit of pent-up demand from buyers at that exact same price point, but the top-end purchase price might have to come down to make the monthly payment about equal. All right, going to move over into a little bit of the data on how people are financing their properties. And when we dug into this in Fairfax County, we saw a pretty good outsized amount of conventional and cash buyers. And I think this is really indicative of the seller focus we've had in our market the last 2 years. When sellers are in control and they're able to be choosy about which buyers they're selling their home to, the big name of the game is certainty of closing. And when you're thinking about what type of loan product somebody's getting, there's a lot of negative connotations surrounding FHA products, Virginia housing products, which gives subsidies to lower income buyers, and some of these other products like VA, where you might not be able to rely on a VA appraiser, one, to do a quick appraisal, but the process for getting them to reconsider value was a little bit tougher than, let's say, a cash buyer or a conventional buyer. In my experience, the VA does a fantastic job on valuations, as well as closing times. As you can see, the average days to close for a VA loan was very close to a conventional. So, the data doesn't play out with what people's perceptions are sometimes on that. But when you can be choosy about who you're selling to, people's perception is if you're getting a conventional loan, you have a higher credit score and you're, a safer bet. And then those cash buyers, you don't have to worry about any kind of financing contingencies or many other issues cropping up throughout the process. One of the other things that we're seeing, a lot of condos being purchased up with all cash. And so from my perspective, that makes a lot of sense with the data of the last few years. Condo prices have appreciated at less than half the rate of single family residences and townhomes over the last 5 years. And so what that means is they are relatively cheaper than buying a single family residence. And then on the other side, we're seeing a lot of people being priced out of purchasing a home. And so the only thing that keeps rental prices in check is the ability for people to, spend somewhere else, which is purchasing a home. And so if first-time home buyers are being priced out of purchasing a home and these cash buyers are taking more and more units of stock off the market, it results in them being able to raise their market rents as well to be able to drive the returns that you need when you're doing an all cash purchase. So really what we need here for everything to equal back out is really housing supply. So what Rayne touched on earlier is we've got a lot less homes available for purchase right now. We're down to between 2 and 3 months of supply, whereas we'd like to be closer to more like 4 to 6 months of supply. And that would take a lot of pressure off the market and allow a lot more first-time homebuyers to find something that's more affordable for them. Rayne, anything that you wanted to add on this point?
Well, I just encourage a lot of buyers just to talk to us as realtors, talk to us as loan officers, because we're here to help you find the right place for you. Don't always listen to Bloomberg and CNBC and just believe everything that you're hearing about the market, how the real estate market's going to crash. Now's a horrible time to buy. Talk to us, because we are talking to buyers and sellers day in and day out. And I'm sure, Joe, you're at closing tables all the time. So you've got a good pulse on what's happening in the market. So that's kind of my encouragement to a lot of buyers, especially if it's your first time buying, is talk to us. Find a realtor, find someone that you trust. And if you're not working with someone, I would love to have a conversation with you to see what your situation is.
Yeah, absolutely. On that point, I think a lot of people are asking, is this the right time to buy? There's a lot of panic out there. It's a conversation I have daily of, should I really wait 6 months to see if interest rates come back down? Or if, you're talking about how we need more supply and we're going to get it at some point soon. So should I wait until we have supply and, buyers are a little bit more in control of the process? And from my perspective, the home buying process should really work more like purchasing stocks or, starting your retirement account. Starting early is much better than timing the market. Real estate has market cycles just like the stock market, and trying to figure out exactly where the peak is or where the valley is going to leave a lot of people really feeling poorly about, crap, I missed it by a month or I missed it by 2 months. And from my perspective, if you can afford to lock in your monthly payment to a fixed amount and not have to deal with those huge rent increases that you're going to see year after year, it's really in your best interest.
Yeah, those are great points, Joe. And, I think it's unfortunate for a lot of first-time home buyers that are renting. Their rents are increasing at a faster appreciation than sales appreciation.
That's right. Yeah. And, up on the screen now, I've got an analysis that I've done just using the historical data in Fairfax County, Falls Church area of rent appreciation over the last couple of years versus on the purchasing side, the increase in property taxes and such. And really what we see is that, if we've got a typical small family renting a 2-bedroom for $3,000 or a 3-bedroom for $3,000, if you really want to look at a minimum down payment product, you could buy a $400,000 townhome and your monthly payment would be exactly the same now. But where it really gets scary is if you look even just 2-3 years out at what happens to the rental cost when those costs keep continuing every year versus what happens with a fixed rate mortgage where your principal and interest stays exactly the same. The amount of equity that you gain is absolutely astronomical. And, it's no wonder that a lot of the wealth in this country is built through purchasing real estate. One, you have the built-in savings bank factor, all those principal payments you're paying back to yourself. And then you've got the appreciation over time. Like I said, timing the market is the wrong way to think about real estate. It should be a long-term play. So never buy a home if you're planning to be there, less than 2 years, less than 3 years. You're probably not going to get the value out of it when you think about closing costs on both sides. But really, when you're looking at a longer time horizon, you've got a lot of opportunities to build up some huge amounts of wealth for yourself. Rayne, how are you thinking about a buyer's ability to, you pay themselves back over this long term, and would you ever encourage somebody to sell their home versus maybe rent it out if they could?
Yeah, that's a great point, Joe. I love your analogy with the stock market. I think for people that have that long-term compounded appreciation perspective, I would not sell. I would just hold on to your real estate, let someone rent it out and pay for your mortgage and pay it down, because that's assets that you're going to own free and clear in the future. Now, obviously, some people need to sell in order to pull the equity out of their existing property to buy their next property to upgrade. And that's totally understandable in a market where affordability is very challenging for a lot of buyers. So again, I think my underlining message is definitely talk to a realtor, talk to a loan officer. We are so connected with title companies, contractors, the whole gamut of people that we can help you each step along the way, regardless if you're going to buy or sell or keep renting for a period of time. Talk to us, because that's what we're here for. And we have a really good pulse on the market, and we would love to work with you regardless of your situation. And in Northern Virginia, we have a lot of military personnel and a lot of people that are relocating here to start new jobs, especially some big employers like Boeing and Amazon. They just moved their headquarters to National Landing, and Amazon obviously has HQ2 there. So if you're one of those buyers that are relocating to Northern Virginia, or if you're PCSing, you just got orders to do a permanent change of station to one of the 48 bases in Northern Virginia, we would love to talk to you, because we are so happy that you are serving our country part to serve you and helping you find a place to live in Northern Virginia.
Absolutely. Yeah, I echo all that. I know I get a lot of joy out of my work and helping people understand the complexities of purchasing a home and how to build wealth through real estate. And so I think we'll end the conversation there for this time, Rayne. We'll open up the chat box to anybody who has questions now. But that is the end of our planned content. Thank you, everybody, for joining us today.
Yeah, thanks for joining. Again, Rayne Wu, National Realty, 703-216-2692, RayneWuRealEstate@gmail.com. Give me a call, and we will have this recording available for those of you that couldn't make it, that you could share with other people that might be interested in buying or selling or relocating to Northern Virginia.
Thanks, Rayne. And once again, I'm Joe Garon with Embrace Home Loans, and I'm at 703-727-1651. You all take care. Have a great night.
Yeah, have a great night, everybody. See you next time.